You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody. That music means it's time once again for the Advisor's Option, the program here on the old Options Insider Radio Network, where we break down all the amazing strategies and use cases for options in your portfolios and indeed in your clients' portfolios. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Quite a few programs for you guys to choose from, including many great archived episodes of this program, The Advisor's Option. If you missed our last one, check it out. It's up there in our network feed or on the website or in iTunes, wherever else you get this fine program, including via our mobile app for iOS and Android and the beloved Fire OS. If you missed the last one, we did a deep dive into the ramifications and the impact on volatility of this crazy electoral cycle we've had here in the U.S. If you're kind of scratching your head about some of the impacts of volatility on options and how it plays out and how a big macro event is played out in the option space and some of the impacts it may have on your clients' portfolios as a result, well, then I encourage you to check out that episode. I know a lot of you already have, but check it out if you missed it. It was a fun one. And we have a good one in store for you today. I'm joined. Let's go around the horn. I'm pretty sure he's the farthest, so I'll start with him. We are joined once again by Mr. Chris Hausman, the portfolio and chief technical strategist over there at Swan Global Investments. I believe joining us from scenic and sunny, certainly sunnier and more scenic than it is here today, Puerto Rico. Chris, welcome back to the Advisor's Option program.
Hey, Mark, thanks for having me again. And yes, it is sunny and scenic.
Hey, what is the temperature over there in Puerto Rico, just so you can rub it in my face?
We're looking at about 85 degrees.
Oh, there we go. I think it's going to hit, 3 later this week. So there you go. I think you're winning that one by a nice 80-plus degree differential. So there you go. Congratulations to you, sir. All right. And also joining us, an old friend of the network, and indeed, he's been on this program a few times. It's been a little while. He is Russell Rhoads. He's the head of education over there at the CBOE, also the author of the weighty tome, the mega book, if you haven't checked it out, listeners, Option Strategies for Advisors and Institutions. Just make sure you bring a separate carry-on onto the plane with you because the book is that massive. Russell, welcome back to the program, to you as well, sir.
So if you think my book is massive, does that mean you're overwhelmed by like Archie comics and that sort of thing?
I have it on my desk right now for reference, and I have to have extra bracing on the desk. It is that weighty of a tome, sir.
You keep saying that, and I feel like it's misleading, so I have to chime in that it's only about 110 pages long.
I throw it at my employees here in the studio when I want to scold them, but I have to watch out doing it because it can cause serious damage.
Well, then it floats around like a paper airplane, doesn't
it? Yes, it does indeed. Yes, I am kidding, listeners. It is indeed a much more slight, so if you're overwhelmed by the notion of a huge, oppressive options tome, then this one, a much slender, a novella, if you will, in the options space, then check it out. Options Strategies for Advisors and Institutions breaks down a lot of the stuff we talk about on this program all the time and puts them in some easily digestible nuggets for you guys you can use in your own practice. And last but not least, rounding out our virtual roundtable here on the old program is a newcomer to the show, joining us from the ever-growing Swan contingent over there. He is Ash Vyas. He is the Director of Portfolio Strategy and Overlays over there at Swan Global Investments. Ash, welcome to the Advisors Option Program.
Oh, thank you so much for having me.
And Ash, as we are wont to do with all of our first-timers here on the program, why don't you go ahead and give us a little bit of an overview of your background in the space and what it is you do over there at Swan?
That's a good question. I'm still trying to figure that out. But my background, for the most part, is I've been a professional options trader, starting on the floors of Chicago, and been a portfolio manager for some multi-strategy hedge funds in New York and San Francisco. What I'm here to do at Swan is to help them build out their overlay program to help protect high net worth investors going forward.
All right, and with the team assembled, we're going to dive right on into a very special The Buzz segment.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get The Buzz.
All right, everybody, welcome to The Buzz. Like the man said, this is the portion of the program where we break down some of the latest developments, interesting trends, hot events, big stories, or big breaking research from the world of options that may impact you over there in the advisor space. And as it so happens, we just had a big event not so long ago on the other side of the planet that Mr. Rhoads was kind enough to attend for us as part of his day job. And so he's got a great rundown of it for us. Mr. Rhoads, give us an overview. What the heck is this CBOE Risk Management Asia thing, and why should the advisors out there be interested in it?
Well, the CBOE's, we do 3 risk management conferences a year. The last one each year, at least the past couple of years, has been the Asian version. And basically, risk management brings together buy side, sell side, a lot of volatility focused managers, whether they might be involved in doing some sort of overlay strategy for portfolio managers. We actually even had a kind of a traditional portfolio manager that is starting to dabble in volatility as a diversification tool as one of the speakers. All the speakers are practitioners that to use one of your phrases, will share their pearls of wisdom as far as how they go about doing things. A lot of the Q&A sessions are almost like the it's almost like a group discussion about how different people are approaching the markets. We always have a couple of educational sessions in there as well. My role over there is I write a blog for the CBOE website where I talk about, I basically give some brief recaps of all the different presentations. then give a summary of what the conference was like and what themes were being taken away from the conference. It's really interesting to get a diverse number of market participants in the same place, and especially when you're coming up on a new year, to get people's outlooks into 2017 and that sort of thing as well. As I mentioned, there's some educational parts. That's usually the first day. We had a gentleman named Dan Passarelli who actually used to work at CBOE, who talked about, he gave an approach to taking directional positions with options, and it's like he snuck a lesson in implied volatility and how at times it's high and at times it's low into his presentation, and why you should take that into consideration before you're doing a trade. We had a couple of people from CBOE talk about relatively new things that are coming out of the exchange. Several different types of strategy indexes have been developed here and continue to be developed. We talked about the performance of some of the consistent option writing strategies that we have benchmark indexes around. I like to say that we came up with smart beta like 20 years before people started talking about smart beta, with the buy right index, and then the wide variety of offshoots relative to the buy right index. We had a gentleman from research that talked about things that have just come out or are in the works. One of the things that you need to keep an eye out for is a consistent buy right strategy on some of the commodity oriented ETFs. I think it was silver, gold, oil, and the TLT ETF. We're going to have buy right indexes based on those that'll be consistently quoted in the near future. Talked about, also had a presentation that talked about structured products and the different structured product approaches that, based on your market outlook, you might utilize in your portfolio. The second day was very volatility focused. We had Rebecca Chung, who is the derivatives analyst. I think she's in charge of derivatives analysis for the Americas for UBS. Just talk about what's worked as of late, some of the different strategies that she recommends to clients when they are concerned about a sell-off in the market, or basically how to use volatility as a hedging tool. And then the afternoon part of the second day, which was also the final day, we had a couple of portfolio, or a couple of people present about short volatility strategies, and one of them was actually the gentleman I mentioned before, who is more of a traditional portfolio manager, who talked about how he has been incorporating short volatility strategies into his portfolio. And he's not just, when you hear that, you normally think, okay, something that is short VIX. But actually, he has been working on ways to get short volatility exposure to a variety of asset classes, and by getting exposure with a variety of asset classes, he's seeing even better diversification benefits. We then had a couple of not portfolio managers. I've got portfolio on the mind because of the subject of this program, but we had a couple of volatility analysts who talked about the different ways to get long volatility exposure. One of them actually said if you're always long volatility, you're going to feel the burn. They even put a picture of Bernie Sanders up there, because you're going to be consistently losing money unless you come up with some way to try to pay for the long volatility exposure, maybe through an option spread or something else. And then the last session of the whole program was a panel discussion guided by Stephen Sears over at Barron's, where we combined long and short and opportunistic traders to discuss how they approach derivatives and volatility. So a wide variety of topics, a very professional level conference. When individual traders ask me if I think risk management would be worthwhile for them, I kind of steer them toward other conferences, because it really is a very high-end professional level conference.
And it's not just Asian volatility you guys talk about. In fact, this is only, I believe, the second year of RMC Asia. But you guys have been doing it domestically for a long time. I know it rotates back and forth between I think Florida and California each year, or every other year, I should say. And you've even added a European contingent. So I think if there's a lot of our listeners out there who are intrigued, whether they're U.S. or European-based, you guys have an offering for them as well.
Yeah, we've got the fall. We do Europe and Asia. Next year, Europe is going to be in suburban London. I can't remember exactly where. And we are going to we're going to have that one, I think, the week after Labor Day. And then the U.S. version is always in the spring, and it goes back and forth. This year it's going to be in Dana Point, California, March 8th through 10th. In fact, the press release about that one went out on Friday. So registration may be open for that in the near future. As we start to get the schedule put together, we'll put some information out about that. So, yeah, we do it in 3 places now. And as you mentioned, we've been doing the U.S. one for a while. The U.S. version, this will be the 33rd annual. So it's been going on for some time.
Hey, Russell, it's Chris. Were you able to get a good gauge on the level of sophistication over there as far as incorporating volatility strategies in the portfolio management space?
Yeah, they're not quite as far along as we are, and that's just because they don't have any actively tradable volatility markets in Asia. The closest thing is they do have VIX futures on the ASX 200 in Australia. They know VIX. They tend not to have exposure in that way to volatility. They tend to use different types of option spreads, but then the option markets over there are fairly limited. So a big portion of what is actually done in Asia with respect to the option market is done in the SPX. And the extended hours have helped grow that over there as well. There's more interest when you're in Asia for long volatility exposure than hitting a bunch of singles, and I think that's kind of the nature of trading in that part of the world compared to our part of the world. And when I say hitting a bunch of singles, I mean short volatility strategies. So they know the markets. There was a lot of interest with Dan Passarelli's presentation where he was talking about how implied volatility can be historically low or historically high, and that should come into play if you're thinking about making a directional trade. I had seen that presentation before we went over there, and I think the same presentation in the U.S. Might not have garnered as much interest because it's it was a lot of those of us that have experience. Yeah, we know that, but it was new to a lot of the people attending the version out there in Hong Kong.
That's not surprising to me. That is kind of what I've heard from a lot of other people who have been exploring the Chinese options market, the very nascent Chinese options and derivatives market for the last few years as it's been growing. The very different use case over there. You're right. Everyone over here, particularly if you're talking active retail, and a lot of the audience of this show as well, the active advisors and asset managers are in it for the income generation. They're in it for, you're right, a lot of short singles, writing weekly or monthly options to generate additional income for a portfolio. But over there, it's a very different use case. They're very speculative, and you're right, very long premium in nature. They're buying calls to speculate on an index popping or an underlying popping, and they're buying puts for the same use case. So it's a very different mindset, very different use case. So it doesn't surprise me that a presentation aimed at long volatility, aka long premium traders, would resonate with that audience. I guess that's kind of confirms what I've heard a lot about that area over there. And Chris, interesting for you guys over there, and Ash as well, you guys over there at Swan. I'm curious your thoughts on the RMC. I know you haven't been to RMC Asia. I know I've run into a few Swan guys in the past at some of the U.S. versions of the risk management conference, including the one I think this past year in Florida. It's near one of your Swan HQs there in Florida. But I'm curious, A, have either of you guys attended, and B, what are your thoughts on this kind of event, which is very much in many ways tailor-made for the audience of this program?
Yeah, no, they're great events. I mean, I think the CBOE does a tremendous job, and now they're reaching out to Asia, and Russell can chime in on this one. I think they're going to reach out to Latin America as well. So it's a great way to get the message out there. It's a great way to tap into some of these markets that are less sophisticated, as we touched on. And and guys like Russell are out there, hitting the pavement and educating the world about options, and that they can add value, and they're not just going to be speculative things in other parts of the world. So I know Ash has some experience at the CBOE conferences. I'll let him give his take as well.
Yeah. I was honored a few years back in 2013 to speak at the U.S. conference on the subject of left and right tail risk. I was running a tail hedge fund at the time. So I thought it was a great event. We bring the buy side, the sell side, and risk management together, and people get a really balanced perspective of how options can be used both to make money and to mitigate risk.
Yeah, it is an interesting event. If you want to learn more, listeners, obviously you missed the Asia one, but I don't think they have any presentations on available online from that one. I know they have them from the mainline RMC. Search for CBOE RMC or search for Risk Management Conference, and all the presentations and everything else, videos, including some featuring our friend here, Mr. Rhoads, will pop up for you. You can get a nice overlay. If you want to really deep dive into it, we did a deep dive into it over there on our Volatility Views program from this just went live this morning. So check that out on the network there as well if you haven't done so already. And I was going to save this till the end of the show, guys, but this thing is just burning it up, so we have to move it out of the office hours into the buzz, because clearly it's buzzing with our audience. We put out every week a question, a poll to our audience, our options question of the week. And so we thought, since we're kicking off the week this week with an advisor show, let's do something aimed at the advisors. And quite frankly, I thought it would be one of our quieter poll questions. And it's proven to be exactly the opposite. This may be the fastest uptake rate we've ever seen on a poll. This thing's supposed to be going all week, and it's already got a ton of feedback, a ton of response. It's only been up for a couple of hours. We have a whole week to go on this thing. In fact, this thing, usually our benchmark for these types of things, the fastest response rates we get, usually somewhere around like an Apple or VIX. That's when you post something about that, people flood into it. The advisor questions blowing the doors off all of those. So that is impressive. People clearly have advisors and options on the brain, at least in our audience. So we had to float it to the front of the show. I want to get your guys' thoughts on this as well. Our question of the week this week is: we said, hey, financial advisors represent the last options frontier. So what level of options knowledge do you actually expect from your advisor? And we gave them 4 choices. We said, we kind of broke it down, kind of like your levels of approval at a brokerage firm. So we said none, you'll do it yourself. Or level 1, which is pretty much just buying puts and calls. Or level 2, which is generating some income from writing options and have a general knowledge of volatility and things like that. Excuse me. Or level 3, your financial advisor is an option specialist. It's kind of all they do, kind of like a swan or something like that. So I'm kind of curious. Maybe Russell, we'll start with you. I kind of know your pick, but what would your pick be? hopefully I know what your pick would be. And then B, what do you think is winning our surprisingly active poll here?
What did you think my choice would be?
I will. I think you're gonna pick none. You want advisors not to touch it, of course.
Oh, no.
Says the man who wrote the book.
So that's what they're getting paid for.
Exactly.
Let me see. I would say level 2 income and volatility is what I would want at minimum. And I would think that level 3 would be winning. Be an options specialist.
Yeah, I mean, we do have a bit of a, shall we say, a targeted audience. So you might think we're a little bit, most of our audience is down the options rabbit hole. So you might think level 3 will be. I won't bias you with what the results are yet, but yeah, the results are kind of interesting. Chris, same question for you. Which of these would be your choice? And then B, what do you think is actually winning our poll here?
Well, financial advisors have a huge task in front of them. They are expected to know a lot about many different topics, right? So that they can choose the best thing for their clients. They are getting in the option space more and more, as this show is one of the examples and why we do it. But I do think they have to have a good knowledge of income and volatility so that they can go to the next step and recommend who the option specialists are. As far as what's winning out here, I'm going to have to say level 2, income and volatility is probably what's winning at this point.
Oh, going with Russell. 2 votes for level 2. We'll see. Ash, maybe you'll be the person who makes it 3 for 3, or maybe you'll go somewhere else. What do you think? What would your vote be? And then B, what do you think is winning our very contentious poll here?
Yeah, I can't be very controversial here, unfortunately. I would say level 2 as well, simply because I think, as Chris stated, there's a huge task in front of financial advisors these days. I think you need a bit more sophistication than just simple puts and calls. I think you need to be able to use, the asymmetric properties of option spreads, especially in an environment like this with all the uncertainty. But I think a full-blown option expert, that's too much. That's asking a lot and a real strain on people's time. So I would say level 2 is what I think is optimal, and level 2 is probably what I would think would be winning.
How very nice and conciliatory of all of you. Yeah, I was kind of curious because our audience they do lean toward the hardcore. So I kind of thought they would expect either a level 3, which is someone who's going to do it all for them, or just nothing, I'll do it all myself. I kind of thought one of those two would be winning, and that certainly is the way it's breaking down so far, with about nearly half, 44%, saying nothing, they'll do it themselves. So I'm not sure if they don't trust their advisor to do it, or they're just super down the rabbit hole, and so that's kind of how they lean. But so far that's winning. Number 2 is level 3 with an option specialist. So they want to go to someone. They figure if they're going to go to all the trouble of getting a financial advisor, they want someone who actually understands options. And I'd imagine for a lot of our audience, that includes using options as a surrogate for the underlying a lot. They don't want to play around with stocks unless maybe they have to in like an IRA or a 401k or something like that. And then 20%, but 19% actually for level 1, buying puts and calls. And you're all 3 of yours choice. Level 2 coming in a distant 4th. Only 15% saying level 2, income and volatility. So some surprising results. People are just flocking to this one. Apparently, people have advisors and options on the brain. If you had told me that we'd have a faster response rate for an advisor question than something like a VIX or an Apple, I would have said you're crazy. But people clearly have this on the brain. Maybe it's because of what some of our other things that are going on in the space right now. By the way, if you want to vote on this, it just went live a couple of hours ago. So we have all week to vote, even though a lot of people have already voted already. But you have all week to vote. Find it over there at Options on Twitter. We'll put the link in the show notes so you can do it as well. And I think one of the reasons a lot of people have advisors and options on the brain is because longtime listeners of this program will know a very, very contentious topic in the advisor space for some time was the Department of Labor fiduciary rule and its impact, not just the broad impact on the entire space, but also very particularly for the option space, because options were effectively banned or prohibited by the Department of Labor rule, at least in its initial incarnation, because they created a list of effectively approved assets and options were not on it. So whenever you create a list and you leave something off, you have effectively prohibited that item. After a lot of consternation and hand-wringing and lobbying by the industry, that was fixed back in, I believe, the April timeframe. But still, this DOL fiduciary rule has been very contentious. Now, of course, post-U.S. election, it has heated up yet again with a lot of talk in the Trump regime of rolling back a lot of regulatory reforms, including Dodd-Frank and, of course, the Department of Labor. Now we're seeing a lot of people getting into this fray yet again. Betterment, which is a well-known player in the robo-advisor kind of automated advising space, and they took out a huge full-page ad in the Wall Street Journal recently, effectively trying to lobby on behalf of keeping the fiduciary rule, saying it's in the best interest of the clients to have advisors put their interests first rather than generating some sort of fees or selling commission-based products and things like that. And certainly on the surface, that rule makes a lot of sense. I think some people have taken issue with the way it's been implemented, but on the surface, it makes sense. Of course, a firm like Betterment makes they have some skin in this game as well. So perhaps it's not entirely altruistic their outlook, but still a lot of firms have been diving into that fray as a result. We're also hearing a lot of talk out of potential appointees. We don't want to get too political on the show, but it's kind of hard to separate regulation and politics sometimes. A lot of people on the short list for Treasury Secretary have said that if they were nominated, that they would in fact work work to kill the Department of Labor rule, which is, of course, what we're talking about here, the fiduciary rule. Trump himself has said he's not a fan of that. And a lot of Congress is also, they don't like the notion of such a broad, sweeping piece of regulation coming from an area that they have no real say over. They wanted to come through Congress, so there's a lot of thought on that as well. And in fact, even if that wasn't enough, Trump's pick for the new Department of Labor chief also said to be very anti this recent Department of Labor fiduciary rule. So it seems like a lot of cards, a lot of chips are stacking up against this rule, which, as much noise as it's caused, as much consternation and hand-wringing as it's caused, isn't really even fully in effect, doesn't come fully in effect until next April. So it seems like we've been talking about this forever, and on this program I think we have. But it is a very important piece of legislation, or important piece of reform here, and if it stays or if it doesn't stay, it's going to have a lot of impacts on this space. And there's a lot to kind of unpack here, and again, we don't want to get too political on this show, but it is an interesting thing, and it seems like, Chris, just at the big Swan conference in Puerto Rico, something like that was just a few months ago, this was one of the dominating topics of discussion was what was going to happen with this Department of Labor rule. Were they going to allow options? It seems like all of that had been settled. The ink was dry. Options were allowed. And now it seems like a few months later, with a new presidential regime coming into power, we may have all of this rolled back again. So what are your thoughts on this? Do you think we're going to have a lot more uncertainty on this, and as well as other financial regulatory things going forward? And B, is this going to be a big topic of conversation at next year's big Swan gathering in Puerto Rico or elsewhere?
Well, Mark, you were right. I hosted that panel, and this was one of the things that we talked about, the DOL. Everyone's worried about the whole categorization of where options were going to fall. So it looks like we're starting to steer in the right direction. It would be crazy not to let options in portfolios or financial advisors recommend that, because they're great hedging tools. They're great tools to raise income in portfolios. So it's good to see that cooler heads are prevailing, especially in the option space, and that we are going the right way. We'll probably touch on this again and see what's going on and follow this. I mean, this is affecting a lot of people and a lot of businesses. It could affect a lot of investors. And so I think it is definitely something that we're going to have to keep a pulse on. And our next CIO conference, we'll definitely talk about it and see review where it was, just kind of what you said, review where it was a year ago and see what kind of changes are happening. So I think the consternation over the rule is, with the Trump administration and their plans on abolishing it or changing it to be a little bit more conducive towards the options industry is a good thing. It's a good thing for financial advisors. It's a good thing for anyone that manages money. And at the end of the day, it's the best thing for investors.
Ash, same question for you. Obviously, it's a bit of a fluid situation right now, but what are your thoughts on this ever-evolving, the DOL rule, obviously, in particular, very much impacts this space, but also the apparently now fluid again nature of a lot of the financial reform we've seen coming to the space in recent years?
I think I would actually concur with Chris that it is a net positive, particularly given some of the feedback we've gotten from the new administration, particularly when we consider the backdrop of what we've seen in interest rates and perhaps a return towards normalization. That tends to come hand in hand with increased volatility, and therefore the utility of puts as a risk mitigation vehicle is enhanced. So, I think it does, as Chris stated, it does benefit investors if there is a bit of a sea change along those lines.
Yeah, it certainly is a contentious one. Russell, as the man who literally wrote the book, the very, very weighty tome on all things options and advisors, I know the book is more purely aimed at strategies, but it's kind of hard to divorce the two now. You can't really talk options and advisors without at least mentioning the fluid nature of the regulatory regime right now. You spent a lot of time talking to advisors and asset managers, just came back to talking with them in Asia. You go to a lot of other conferences and things. Is this very much top of mind for a lot of this audience, and are they as confused as the rest of us about what the heck this means for them going forward?
I like the word confused that you just used, but I think probably a better term would be wait and see. Like just about everything it's almost like nobody wants, and this goes beyond our industry. It's like nobody wants to predict anything that is going to come out of the next administration. because people don't like to predict things and be wrong, but because there really isn't a lot of guidance, and if things are said in passing, sometimes you don't know whether to believe them or not. So I think we're in a wait and see. Let's see what happens after January 20th, and we'll believe whatever ends up happening and when it happens. I do believe that kind of philosophy behind the next administration is going to be to make to lower the regulatory environment. But I do believe that I like to believe that they're going to keep things at a level where people are still being protected. So I hope that there's going to be a happy medium in there.
Well, speaking of happy, it seems like a lot of wealthy investors are happy right now with what we're seeing post-election. UBS took a survey of about 1,200 what they term affluent and high net worth investors, and kind of get their sentiment before the election, so mid-October, and then immediately afterward. And they found, surprise, surprise, a lot of them are happier now. I think the massive spike in the markets may have had something to do with that. But again, they took the second part of the survey right after the election, so I think the immediate impacts on the market had yet to be felt at that point. But they said of this 1,200 they polled, 48% of them felt optimistic about the 12-month economic outlook. That was up from a little over a third prior to the election, so mid-October. So an increase in net optimism. The poll also found that Trump being an outsider to Washington was critical to his election. 90% of the people who said they voted for him said they voted for him for that and for disruption. And so interesting. And about 2/3 saying it's going to be a catalyst for change, I guess whether they liked him or not. They think it's going to change a lot. They say before the election, 55% of those high net worth investors reported making portfolio changes to protect their money. 30% increased cash. 25% shifted to more conservative asset allocation. I wish this was as specific of a study that could have asked them if hey, maybe did you buy a put? That would be great to know. They didn't get that specific, unfortunately. Only 9%, they said, ahead of the election increased their investments in the U.S. stock market. I'm sure all of them, 100%, are wishing they did that now in hindsight. Let's see. And they said, yeah, including this, about 33%, so again, a third of those plan to increase their investment in the stock market now and also increase personal spending. That was of Trump supporters, I should say. Only 28% of Clinton supporters said they were doing the same. So interesting how it breaks down along party lines and along who they voted for. Speaking of who they voted for, since we're talking all things Trump and elections, interesting, another poll out there. This one was from FSI. They polled financial advisors. They polled over 1,300 financial advisors and asked them, just quite simply, who did you vote for? And if you said they voted for Trump, you are correct by a very not surprising, but overwhelming amount. 71% voted for Trump. Only 19% voted for Hillary, and then the remaining 10% just not answering or going third party. So people probably could have assumed there'd be some support there. Whether it would be that extent, I think is kind of surprising. So a couple of little interesting election and Trump-related factoids coming out here that affluent investors, again, the clients of a lot of our audience, are certainly happy, I guess, with the way things turned out, and that a lot of the actual listeners of our program voting for Trump in this election. Anything surprising there, Chris or Ash, or perhaps Russell here of those numbers? Not entirely out of left field, but maybe the depth of the response kind of somewhat surprising.
Well, it seems like the winners are finally speaking up, because before the elections, all the polls were stating that it was going to be a pretty easy win for the Clinton administration. And when they asked people, well, who did you vote for? There was a lot of people that didn't want to answer. So finally, people are starting to come out and saying, yeah, I voted for Trump. I voted for this administration. And, the markets, again, I was wondering earlier in the show, I was like, for me, this has been a year of a lot of people getting a lot of things wrong. If you go back to the first quarter of this year, and Russell can chime in on this as well, there was so much volatility, and the bear market was back and volatility was here to stay. That quickly changed. Brexit, the polls were wrong. The presidential election, those polls were wrong. In addition to what was going to happen if there was a Trump election, right? There was going to be chaos in the streets. The market was going to go down 10%, and pretty much all these events, the majority or the people who've been speaking the loudest before the event happens have been wrong. And now you're seeing, hey, there is a majority out there that are right. They're just not speaking up, and we have to start shifting focus on, do these polls really have a lot of credence? Should we be making financial decisions based on a lot of polls? And that's when kind of, a long-term plan of sound money management is important. So it's just one of those things. I mean, Ash and I were kind of talking about it and like, wow, so many people have been wrong this year, or is it just these polls or how these polls are being conducted, et cetera? So, I guess I was certainly surprised by the election results. I'm not going to lie, but I guess I got to stop watching the media as much and make my own decisions.
Yeah, that's something we were commenting on some of our other programs on the network, and we saw it going into Brexit again in our U.S. election here, that you're right, the markets were just moving dramatically based off of polls. Look at the Monday of election week when it seemed like, Hillary was leading in the polls again and the market was surging. Or pre-Brexit that week, the market was rallying. Volatility was coming off pretty aggressively, if you remember, going into the actual Brexit vote that week, and that was because of some polls showing that in the UK it seemed like Brexit wasn't going to happen. And we said on all of our shows, this seems like a pretty dicey proposition to be selling actual volatility going into a big event like this ahead of nothing more than just a poll. And sure enough, we saw how that played off for everyone involved in both events. So you're right. Maybe we put collectively and in the market certainly a little bit too much stock on things that clearly don't have their methodology worked out yet. That wasn't enough for the impact, some of the election stuff here. And this is the last one, I promise. Listeners, in case you're just done with all things election, it is our final show for the year here, so we got to get all these little nuggets in. But looking at U.S.-based ETFs, Lipper manages, or Lipper tracks a lot of those, obviously, as well. And they said post the election that week, it was the largest weekly inflows for U.S.-based ETFs on their records. They took in $27 billion. Again, their records go back about 20 years to 1996. That's back when ETFs were pretty much just a very, very small fraction of what they represent today. So this is a huge inflow. People clearly responding. So if the massive rally in the markets wasn't enough to show people, hey, we're buying stocks and buying ETFs, then these massive inflows also should be enough to confirm that. So interesting stuff, a lot of surprising results from, I think, what all of us can term a very surprising election, an election that now has cast a lot of what we thought was already kind of set in concrete regulation, now cast it back into the fluid space. So I think we'll be talking a lot more about this, fortunately or perhaps unfortunately, depending on your view, in the coming months. But meanwhile, though, we got a little bit of time left in the show. We got a lot of guys writing in with questions. I want to make sure we get to some of you. So we're going to keep on rolling right on into our office hour segment.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to the office hours segment, the portion of the show where you guys dictate what we talk about with your questions, your comments. We got a lot of them coming in. Let's see how many we can get to here. Let's start off with this one here from Zachary. He asks us a very common theme, but it's worth reinvestigating and re-looking at every now and then on the show as well, because it's such an important question for so many of you out there in the audience. He asks, I'm learning a lot about options from your program. Well, you're welcome, Zachary. He says, goes on to say, I'm a relatively new convert, so I apologize if you've discussed this on past episodes, but exactly how much of my portfolio should I allocate to defensive strategies like puts? Thank you for providing so much great free content. And he is correct. We have touched on this in the past, but it has been some time, I think, since we've had a discussion on it on this show. And again, it's worth re-investigating every now and then because it is such an important topic. I've said my piece on this, I think, in the past, so I'll wait till after you guys have all chimed in. I don't want to color the conversation. Russell, we'll start with you as the man who literally wrote the book, the weighty, massive, epic tome on all things options and advisors. When some of them come to you asking this exact question, hey, I'm a long equity guy, how much of my portfolio should I be spending on these put things? What do you tell them?
It depends.
That's no fun. Really, you got to say 1.6%.
Fun, but I know that. Okay, 12.5%. No, it really does depend the nature of the portfolio. If you're like, a long-term, long only investor, it would really depend on your shorter-term market outlook and how defensive you want to be at times. So, and then on the other side of things, if you're taking directional bets and that's how you're using the option market, that part would be dictated by, how bearish or how bullish you happen to be on the overall market. But then I would suggest if you're going to think about buying puts because you're bearish on something, maybe you consider spreads or something else to offset, the time decay, which we feel the burn if we only buy options, because we've got to overcome time decay, which is very difficult to do without implementing some sort of short strategy. But it depends on the nature of the portfolio, unfortunately. And if you're just talking about a trading portfolio, it could be 90% sometimes if you're more bearish than bullish on the overall market. I know you hate the it depends, but that's the final thought behind that, is it just kind of depends.
Hopefully, if you're spending 90% of your portfolio on protection, maybe you just go to cash in that environment and save yourself 90%.
If you're very speculative, and I guess this isn't the right program for very speculative, that may be, that it may make sense at times. I think that you probably want to have a mixture of long and short positions, but if you're having a very difficult time coming up with something to be bullish on, that might just end up being the waiting from time to time.
I, of course, was just joking. We do have long short players. Not many, a lot of them mostly in long only in this audience in particular, but which is probably kind of how we're terming the question. But if you want to go dark side like Russell, you can go that way. Cash is not the only option. In fact, it's not the preferred option, pun intended, and literally here on this program. Ash, same question for you. Obviously, this is something you guys wrestle with a lot over there at Swan, and with new clients coming on board to the DRS, they want to know, how much should be allocated to this stuff and how you guys work to minimize that outlay. So what do you have to say for an advisor out there, kind of new to options? Sounds like he didn't mention it, but I'm assuming he's a long equity guy, probably tracking the S&P up, tracking the S&P down. What do you say to a guy like that? How much of his portfolio should he be allocating to some sort of defensive allocation like puts?
I would say larger than historic, and primarily that takes into account where bonds are. Like in the past, people would do the traditional 60-40 allocation or something along those lines. The bonds don't necessarily have the room to protect the portfolio like they did pre-financial crisis, et cetera. So I think to be more specific, it depends on what your client's investment objectives are and what sort of drawdown they could stomach. If they can stomach a 10 to 15% drawdown, it's more of a tail hedge scenario, you don't need to allocate as much, maybe 2 to 4%. But if you want a long-term systemic hedge where the protection kicks in earlier with the drawdown, I think what Russell was saying, somewhere in the 10 to 12% range, makes a lot of sense in this environment.
Chris, last question over there to you as well. Obviously, you spend a lot of your days doing exactly this, buying protection and then finding ways to pay for it. So what do you have to say for our friend here, Zachary, who's kind of a new convert to all this stuff?
Yeah, there are some very good ways to effectively put hedges on portfolios. So I don't like to look at how much does a hedge cost, but we like to look at how much risk is in this hedge for a given amount of time. So I think if you risked anywhere from 3 to 5% of your portfolio, you can provide a pretty effective hedge for an overall portfolio. Again, remember, there's a difference between how much should I pay versus how much should I risk. And I think that's that's one of the questions that investors and financial advisors have to really distinguish between, what's my outlay versus what my real risk is here to protect an entire portfolio.
Yeah, there's a lot of different ways to carve up this question, and you're right. It depends on what you're trading, what the market environment is, what your outlook is. There's a lot of different moving parts to this equation. That said, doesn't keep people from trying to get us to give them some sort of general rule of thumb, some sort of yardstick. So what I typically tend to tell people, and again, it varies depending on the scenario, but if you look at someone coming to us in this kind of proverbial scenario, they're traditionally long equity, usually S&P. They're maybe worried about a near-term drawdown, but not an aggressive one. They want a little bit of out-of-money protection, but not a ton. They want to have it for the next, let's say, somewhere in the next 3 to so months, next quarter or so, they want that protection. Then we say somewhere in that 1.5% to 2% outlay range seems to be a decent ballpark, a good starting point. And obviously there are things you could do to mitigate that. Russell's talking about spreads. Obviously, you guys in Swan do a lot of writing options against the long option to mitigate that. So as you get more savvy, you could reduce that outlay. But that's a good, I think, starting point. And as you start looking at what your portfolio is, what your outlay is, maybe you want to go like Russell says and shift short anyway, in which case it's a different conversation. But that seems to be a decent ballpark. And then people can, so at least they have something to wrap their heads around and say, okay, if I'm comfortable, if I made X percent so far and I want to spend 2% of that portfolio to protect all those gains, I can at least have something to wrap my head around. That seems to be a decent starting point. Again, not going to apply to everyone, but if you start from there and work up or down, hopefully down in cost, then as you get more sophisticated with options, then you could do a lot of interesting things. All right, let's see. We've got time for maybe one or two more. Let's mix it up a little bit. Here's a silly one from Rico Landa. He wants to know, did you guys see this? He sent us a link. He says, he's talking about Mark Cuban. Is Cuban talking about buying puts or something else? Guess he has a savvy financial advisor. And he sent us a link to an article. This was right before the election. He sent it to us saying, Mark Cuban put the biggest hedge on he's ever had due to Trump. So he obviously not a fan of Trump's. He was worried about a market correction if Trump won. Turns out, not exactly what happened. So if he did buy puts, they went out worthless. He probably is happy about that. But yeah, if this was anybody else, I would say they probably put on some sort of defensive asset allocation, switch to cash, went into fixed income, et cetera. But Mark Cuban actually has a history of hedging with puts. In fact, he very infamously, back in his broadcast.com day when he got, I believe it was Yahoo shares in exchange for broadcast.com, about $1 billion or so worth of Yahoo stock, which they were kind of just giving away at the time, was worth somewhere around $400 a share. So they were just giving it away pretty much for acquiring everything under the sun back in those heady .com days. Mark Cuban was one of the few who had the sophistication, the savvy, or perhaps his financial advisor did, to actually tell him, hey, maybe you want to buy a couple of puts on their Yahoo thing. And it turned out to be a pretty good investment, because not too long after is when we had the whole .com meltdown, and those broadcast.com shares were pretty much worthless, and or the Yahoo shares that he got as a result of broadcast.com were worthless. So it worked out for him, and now, of course, we have a reality TV magnate and sports owner and whatever else he is. So yeah, I think it's an interesting question, and I do think if it's anybody else, probably not. But yeah, for your buddy Mr. Cuban there, Russell, he probably was buying puts. What do you think?
He actually, what you were talking about back in the Yahoo days, he actually put a collar on. So I wonder, when I heard him say that, and I publicly heard that he was thinking about hedging himself because he was, because he thought that a Trump victory was going to be bad for stocks. I wonder if he did a collar instead of buying puts. I haven't seen if he said what he was going to do trading wise, and if he did a collar, he might not be particularly happy about it, because he
had less of a smile.
Probably gave up some upside. And I'd love to know what the time frame is as well. When he got the Yahoo shares for selling out broadcast.com, he had an 18-month lockup, and that was one of the reasons that he hedged. It was because he didn't want to. He didn't want to sit there and see what Yahoo did for the next 18 months. I don't know if he realized it was going to go down as much as it did, but it's sometimes the legend is better than what really happened. Either way, we would not have him as a personality, for better or worse, if he hadn't put that collar on.
Oh,
so if he put a collar on, he's probably not as happy as if he had purchased puts.
How did I know you'd be well versed in the trading strategies of reality TV stars? I just knew. I knew to toss to you on that one. Anything to add there, Ash or Chris, on the hedging savvy or perhaps lack thereof of reality TV star Mark Cuban?
Well, I'll throw this one to Ash. I mean, I'm kind of like what Russell said. I mean, some type of strategy that's obviously buying puts, could be a collar. You know, he could have been doing some put back spreads, perhaps. I don't know the level of sophistication that, you know, he was probably doing or how much he really wanted to hedge. He says it's the biggest hedge he's ever had. So who knows what that real number is, you know?
All right, we got time for, I think, one more. We'll take a left field one because we get some every now and then on this show. And this one seems like the more appropriate of our shows. He sent it into this program. I'm not sure why, but it comes from fun concept, not really pertaining to options. He wants to know, he says, do you think activist investors will encounter more opportunities in the U.S.? It seems like they are in the U.K. Well, he's obviously based in the U.K., probably more familiar with the local activist investor scene than perhaps we are. Not a topic we talk about a lot here on the network, activist investors. Maybe as a few guys like Icon and others, or maybe more adjutant investors. They certainly impact options quite a bit, and names like Apple and others. But we don't talk activist investors that much. I don't know, maybe Ash, do you have any thoughts on this in general? Is this an area you watch? And anything you want to share with our friend here, Mr. or perhaps Mrs. Fund Concept?
Well, it's not an area that we actively watch, but I would think that you're seeing a lot of correlation globally. Like, for example, you're seeing things like Brexit was a shocker, the Trump thing was a bit of a shocker. If you're seeing that sort of stuff in Europe, this lets increase the fact that you might see this. I mean, if the current administration does follow through on some of the campaign promises to bring a lot of money back into the States from overseas, historically companies tend to take that money and buy back their shares, which drives prices up, and you might actually see a bit more activist involvement along those lines. But it's still early. I guess we'll see.
Russell or Chris, anything on this? Not a topic, again, we usually address, but it's always fun to have a little out of left field one at the end here. Anything, Chris or Russell, to add for Mr. perhaps Mrs. Fund Concept?
Well,
I'm sorry, Russell. It's not an area like I said that we follow, so I guess I'll turn it over.
All I was going to say is typically if you get somebody in there that's like an activist investor, the way I envision it is Danny DeVito played one in some movie back in the day where he found a factory that the parts were worth more than the sum, which meant it was undervalued. And with most equities being at the top end of the valuation range in this day and age, I wonder if it's going to be a decent environment for people to come in and do things like that, where they're trying to take an active role in what's going on in a company because they don't think it's being managed right or because it's undervalued. And we just don't have a lot of undervalued situations right now.
I believe, if I know my 80s financial films correctly, I believe that was Other People's Money.
Yes. Thank you.
One of the few Danny DeVito financial films on record, which is probably why it stands out. All right, great questions, everybody. That's going to do it for our office hours segment. It's also going to do it for this episode of The Advisor's Option. But before we go around the horn one last time, check in back with our panelists, our cohorts, see what they have coming down the pike that may interest you. Our friends over at OCC and Eric couldn't be here today, so again, as always, head on over to optionseducation.org. You'll see right on the homepage there, at the far right nav bar, you'll see Advisors. Click on that tab, and all the gateway will be open to you. All the great studies you talk about on this program and others on the network that pertain to advisors and how they use options and how your clients may want to use options. It's all there for you, including the great buy, right, and collar studies they've done over there in the past. So if you want a lot of data to arm yourselves when you're sitting down with your clients to talk options, optionseducation.org has you covered. And Mr. Rhoads as our guest, what is cooking and where can people go if they want to find this weighty tome of yours about all things options and advisors?
Oh, well, it's on Amazon if you just put my name in along with the other books that I have written. So it's not hard to find if you want to find it. We're coming to the end of the year here. We're planning out classes for next year. The first class that we're gonna do is going to be in late January, and it's actually going to be on generating trading ideas by using fundamental analysis and technical analysis, and then combining it with what's going on in the option market. So it's going to be a relatively new class for us at the Options Institute.
There you go. Check it out. Search for Options Institute if you want to register for those classes and check them out. They do some virtual stuff too as well if you can't make it into Chicago. And if you want to find Russell's book, just search for Russell. That's 2 S's, 2 L's, and then his last name is Rhoads, Rhoads, not like the island, but just like Rhoads, his own personal spelling. And you'll be able to find that on Amazon as well as the other books he's written up there. And last but certainly not least, Chris and Ash, I know you guys are always working on interesting new stuff over there in the land of Swan. If you guys haven't checked it out, there's a lot of great content up there on the website over there. It's becoming quite the little content portal for advisors. So if you haven't been over there to swanglobalinvestments.com and sometime check it out, click on resources. There's a great resources library. You can, of course, always find archived episodes of this program there as well. Also, the blog. The blog has a lot of interesting stuff there, as well as the quarterly newsletters. If you haven't been over there in a while, check it out. And I know you guys also have the 10th Box events, which I believe, if I'm not mistaken, the URL for that is simply 10th Box. That's the number 10, thbox.com. You can register for those events. So a lot of stuff cooking from you guys. Anything else you want to mention? Anything else coming down the pike that you want to remind our listeners about, Chris and or Vash?
Yeah, as you mentioned, we just wrapped up our 10th Box seminars. They were very well received during the year, so we're going to have another wave of those. And as well, we're planning right now our next all new versions of research and groundbreaking analysis in the options industry.
There you go. Check it out, swanglobalinvestments.com. And on behalf of Chris and Ash and Russell, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. And of course, for sending in so many and varied questions. Maybe we'll do a whole question episode someday because you guys send in just so many to them. We wanted to make sure you get to all of you guys on the program. So maybe we'll do that coming up soon. And we'll see you next time. Actually, we'll see you next time in 2017 for more of The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.